Alright, welcome back to Chapter 5 and supply. Now, we talked about the supply curve moving left and right. When there's an increase in supply, it moves the supply curve to the right. When there's a decrease in supply, it moves the supply curve to the left. Now, if there's a change in price, if the price goes from 3 to 5, then suppliers will supply more because they're getting paid more for every unit they make. If there's a decrease in the price of something, then they'll make less because there's a decrease in the amount of money they make per product. And there are 7 factors that shift the supply curve. First one is resource prices. So this is land, labor, and capital. If one of these things ends up costing more, then you're gonna end up supplying less. Okay, so you're gonna make less because you're spending more money to make each product, and so they need to pay you a sufficient amount to cover that. Otherwise, it's not worth your time economically to make things. Technology improvements will increase supply. All of a sudden, if you're able to produce things much more quickly and cheaper, like faster and cheaper, if there's a machine that does the work of 10 men, all of a sudden you can produce a lot more, and so that your supply will increase. So that'll cause a supply curve shift to the right. The third factor that shifts the supply curve are taxes. Taxes add to the cost of making a product, and so when you add to that cost, you're going to want to produce less because you're making less per unit. Yes, less per unit that you produce. So taxes will actually decrease the supply. Subsidies are when the government pays you to do certain things. So, for instance, the government, maybe it's not cost effective. Farm subsidies are the big ones. So it's not cost effective to grow corn in the United States. It's cheaper just to buy it from Mexico or South America or something. But the government spends money, says, hey, we know it's more expensive to grow corn in the United States, so we're going to actually pay you to sell corn. We're going to pay you to sell corn. So they sell corn for $15. The government gives them another $15. So that way it's cost effective for farmers to keep farming in the United States. Now, the U.S. government does that so people who are farming, one, they produce more food, and then two, they continue being farmers. They continue to have jobs. However, when the government does that, it increases the cost of food for everybody else in the United States. The fifth factor that shifts the supply curve is government regulation. Government can increase or decrease the supply indirectly. For example, the government forces factories to install pollution regulators on the top of all their smokestacks, and the business has to pay for it. Well, a positive thing is we have lower pollution in the United States. A negative thing is that all of a sudden the business loses money Since they lose money, they have to raise their prices and or fire employees. And or fire employees. The sixth factor is the number of sellers. The more sellers there are, the more products. The more products there are, the more competition. The more competition we have, the cheaper they are for consumers to buy. If there's less sellers, there's less products, and it becomes more expensive. Seventh factor is weather. Weather affects some products, other products it doesn't. If there's bad weather in a certain part of the United States, like if there's really bad weather in Florida and there's not as much oranges produced because a lot of the trees die or something, that would decrease the supply. Same thing with good weather might increase the supply of oranges. Now we're going to move on to cost and revenue. Cost and revenue, here you're going to need to imagine that you're running your own business, okay? Imagine that you're running your own business. So you have costs and then you have revenue. Revenue is money that you make. Costs are money that you have to spend to run your business. So you have two types of costs when you run a business. You have fixed costs that are the same no matter what. They're always the same. No matter how many units you produce. Okay? So if I buy a machine that makes tortillas, I have that machine. I paid for it once. I paid for $1,000 for it. I can make millions of tortillas. I don't have to pay any more into that machine. It's a fixed cost. Other examples are like if I'm going to rent a building or an office front, like that's going to be the same amount of money every month regardless of how much money I make. The second type of cost is variable costs. These change with the number of units you produce. It changes with the numbers of units you produce. So, for instance, materials, utilities, hourly employees, etc. If I have that machine that's making tortillas, I can make as many tortillas as you want. The cost of the machine stays the same. However, every time I need to buy more flour to make more tortillas, that's a material. So that's a variable cost. The cost of flour is a variable cost. So this is the equation for total cost. Your total cost to your business is everything you spend on it. So it's going to be fixed costs plus variable costs equal total cost. So you're just adding things up. Just adding things up at this point. Total cost is pretty easy. So example, calculate the total fixed cost, total variable cost, and the total cost for Billy Bob's Pizzeria. His costs are as follows. Rent is $225. Electric bill is $100. Hourly employee salary is $300. A new oven is $400. And his salary is $475. Set. His fixed costs are rent, okay, because it stays the same. The oven, because it'll always stay the same. And then his set salary. Those things are always the same. If you add 225 plus 400 plus 475, it'll add up to $1,100. His variable costs are the electric bill, his hourly employee, which if you add those up will be 400. Now if you add up his variable cost and his fixed cost, you get a total cost of $1,500. Now, average total cost. This is your total cost divided by the quantity produced. This is how much you pay, how much you pay per item produced. So you need to know this because you need to know how much you need to charge per item produced, per thing you want to sell. So using the information above, calculate the average total cost for Billy Bob's Pizzeria if he made 1,000 pizzas. Okay. So average total cost, we take our total cost, we figured out in the last slide, $1,500, and you're going to divide it by the quantity we made, 1,000 pizzas, and it's going to end up being $1.50 per pizza. And it's pretty good, right? Marginal cost. This might get a little confusing. Marginal cost is the cost for producing an additional unit of a good. So just one more. Marginal, when you ever hear marginal, just think of it as additional, like one more. So the change is, or the equation is, marginal cost equals the change in total cost divided by the change in quantity. For example, business currently produces 50,000 cases of Mountain Dew, and its total cost is $3,000. The company then decides to produce 2 more cases, and the total cost raises to $3,010. What is the additional cost of these 2 more cases? So the change in cost is $10. Okay, so $3,010 minus $3,000, you have $10 divided by the two more cases that we produce equals $5. So each of those cases cost us $5. Now, let's move on to revenue really quickly. When you deal with revenue, you have to know 2 equations, okay? Total revenue is price times quantity. And profit or loss, okay, is total revenue minus total cost. Total revenue minus total cost. If this number comes out to be positive, you've made a profit. If this number comes out to be negative, you have made a loss. You have lost money. Need to know that. Need to remember that. Because people get hung up on this all the time. Okay, if it's positive, total revenue minus total cost. If it's positive, you made a profit. Good. Negative, you made a loss. That's bad. So, for example, your firm has $400 in fixed costs, $200 in variable costs, and you produced jeans for $20 and you sold them for $50. And you sold 50 of them. What is your total cost? Total revenue, and do you make a profit or a loss? Well, your total cost is your fixed cost plus your variable costs. So $400 of fixed costs plus $200 in variable costs leads to $600 in total cost. And your total revenue is your price times the quantity sold. Total revenue results $1,000, okay? Now your profit or loss is total revenue minus total cost. It gives you a positive 400. 1,000 minus 600 gives you positive 400, leaves you with a profit. Marginal revenue is how much more money you make for producing an additional good. The equation is total change in revenue divided by the total change in quantity.